Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Chad here, your hosts for this weekend's edition. This weekend show going to be focused more big picture comments for the commodities sector. We're going to start off by talking about the precious metals and the metals broadly, where the next catalyst could come from. And then in the back half of the show, talk energy, oil, and natural gas. A lot of these sectors, or at least gold and oil and even natural gas, kind of range bound over the last little bit. So whether we're in summer trading or whether it's just a pause in the next move higher or lower for any of these commodities, we're going to try to figure out what's on the horizon. Just as a note, please, everyone, go back through our website, kereport.com, and subscribe to our podcast and YouTube channel. Just search The KE Report. That's where you can find all our daily editorials, company updates, and our full weekend show. If you're listening on the radio, you just get more or less isolated segments here. We don't have the full time allotted on the radio to cover all the topics that we do on the weekend show. Let's get into it, kicking off this weekend show with Jeff Christian, managing partner at the CPM Group. Now, Jeff, big picture, I asked you off mic, what's been on your radar for commodities or gold in particular? We'll go through four main topics, starting off with the big, beautiful bill. The tax bill went through everything in the U.S. It got passed, and now we're all sitting here wondering just how bad it's going to be, quite honestly, for the deficit and spending in the U.S. Jeff, what caught your eye about this big, beautiful bill?
Well, there's several things. If you start at the top of it all, when the White House did its estimates of what this bill would do to the deficit and debt, they started with this unsupportable axiom. They said, our actions in the big, beautiful bill are going to boost real GDP growth in the United States to more than 3% on a sustained basis. And when that happens, that will generate so much more revenue that the deficits will actually decline. And we may even be able to reduce the net debt that the government holds. But if you look at real GDP in the United States, we have not had sustained GDP above 3% since the 50s and 60s, the post-war golden days, glory days of the U.S. economy, right? We had a couple years under Reagan and a couple years under Clinton when it was over 3%, but 3% is not a realistic estimate. Most other people are estimating that real GDP will average like 1.5 to 2.5% over the next several years. And at that level, you're going to see $3 to $5 trillion added to deficits over the next 10 years, most of which will be added in the first 3 to 5 years. So you're looking at a big increase in deficits. Another thing we notice is that a lot of the cutbacks in services and everything are scheduled to come in after the 2026 congressional election. So the Republicans in Congress said, if we pass this bill and we start cutting social services, Medicare, Medicaid, SNAP, Social Security, and other things, we don't get reelected. So if we pass this bill now, but we don't start slashing that stuff until after we've been reelected, that's better for us. And that just sort of drives home the self-serving nature of congressional leadership today. It's just really pathetic. So those are two of the big things. Obviously, with the Texas floods, there's a lot of talk about, well, you guys were going to close down the NOAA early warning system. Maybe that's not wise. You were going to close down FEMA. And Trump even said it like Sunday. He said, well, let's wait until after the hurricane season to talk about what we do with FEMA. And so in sum, the big, beautiful bill to me is a mess. It's a negative factor for the economy, long-term and short-term. But the way they're handling it ties in with the way they're handling tariffs and other pieces of economically oriented legislation. It's willy-nilly, it changes from day to day, and it reduces the predictability. So corporations don't really know if it's safe to invest in new plants or new hiring or new equipment. And consumers really don't know what to do. So you've seen a plunge in people looking to buy a house because of the uncertainty. You've seen a skyrocketing in the number of people trying to sell their houses because they want to go to liquidity amidst the uncertainty. So, I look at that bill and I look at it as part of this bigger mashugala, for want of a better word, that is just driving tremendous risks, uncertainties, and anxieties, not only in the United States economy, but globally.
Well, Jeff, with that backdrop and tying it over into the markets and even into the precious metals, do you think that because there's so much of a focus now on debt from really both sides of the aisle, and the sovereign debt issue is always been a narrative in the gold and silver space, do you think that ties into possibly a weak economic outlook, but possibly a boon for precious metals?
I think in the long run, I mean, right now, what we're seeing yesterday and today is people are concerned about interest rates actually rising in the short term. And you have seen short rates and intermediate term rates in the market rising some because of concerns about the debt issues. But I think in the long run, all of this stuff is it's negative for economic growth, and that is positive for gold and silver.
Jeff, is this all negative US dollar then with what the US is doing, all the projections that they're making with how much debt this could add? It seems like the US dollar could continue this retracement.
Well, it's funny because, and you saw these headlines, the New York Times of all people last week, the dollar has fallen lower than it has been since 1973. And that's not true. The dollar is actually sharply higher than it has been for decades, probably since 1973. But what is true is the dollar's off about 10% year to date. And it's now back to levels that it was at the beginning of 2024, late 2023. The dollar's still relatively high. And that reflects this terrible economic reality that if you owe the world enough, you own it. So because Treasury interest-bearing assets are considered one of the least risky debt instruments you can invest in, what's happening is there has been a lot of people buying U.S. Treasuries. They've also been buying into the U.S. stock market because we do have an economic advantage over many other countries. And there's this thought that somehow or other there will be some economic growth coming out of Trump's policies of bringing jobs home. So that has caused investors around the world to buy dollars. You can't invest in the U.S. stock market unless you have dollars. You can't invest in U.S. Treasuries unless you have dollars. So the dollar has actually benefited from the debt crisis that the Treasury is the worst sinner in creating. Yeah. So it's kind of ironic. And you can get a situation, as we've had over the last couple of years, where the dollar and gold and silver all rise together because those are the safe havens in times of economic turmoil.
Well, Jeff, another narrative that we hear a lot about is stagflation, and that if GDP does stay at 1.5 to maybe 2%, as you outlined, and if we do see an uptick in inflation, then in real terms, you could still have mild GDP growth, but still being outpaced by inflation. And so we don't know what tariffs are actually going to put on or when they're going to be put on. But if we weave the tariffs into this discussion, is it possible we get into a situation where we see job losses mount, where unemployment creeps back higher? There's still mild growth in the country, but then it's being outstripped by inflation.
Absolutely. I mean, we've had enormously long period of time with negative real inflation interest rates on U.S. Treasuries, really going back to like 2009, 2010. There are, a couple blips where real inflation adjusted rates got positive. But basically, we have been living in a world where short-term interest rates have not been competitive with gold. And that's been reflected in the gold price. If you go back to 2019, the gold price was $1,040, $1,100, $1,150, and now it's 3,300 something. Yeah. So I do think that you will continue to see, I wouldn't necessarily call it stagflation, but I do think that you're going to have a period of time where inflation is higher than nominal interest rates. And that's going to continue for a while. And it's going to be positive for gold and silver as alternative assets.
Man, we're hearing that stagflation comment thrown around a lot right now, and it does seem like the U.S. is going down that road. But I guess the degree of stagflation, how it filters into markets, that's still up for debate because we've had a number of different commentators saying different things, actually. Jeff, what about investment demand for gold? You focus a lot on investment demand because that really is one of the main price drivers, if not the main price driver for gold. Clearly, there's been some demand there because gold is up around 3,300, but it has mostly trended sideways for the last 2.5 months. So give us some up-to-date stats on what you're seeing in terms of the investment demand for gold.
What we're seeing strong growth in ETFs on a global basis. It's interesting because Chinese ETFs have skyrocketed over the last 2 years or so. They were like 2 million ounces in Chinese ETFs in late 2023, and now there's more than 6 million ounces. So what you're seeing in China is what we're seeing elsewhere as well, is there's a greater interest in having gold price exposure through ETFs. And outside of China, or on a global basis, you've got about 120 million ounces now, 121 million ounces of gold held in ETFs, and that is up, on a year-to-date basis, it's up about 11 million ounces. So you're seeing pretty strong demand for gold ETFs. You're seeing relatively strong demand for futures and options, although that's off some too on a net position basis. I mean, it was up 6.5% in May from April, but it was off. The net long position of institutional investors was off 24% from May of 2024. So you're seeing some reduction there, but it's still very high. You're seeing fewer coins being bought by investors, I guess partly because a lot of people who buy coins don't want to pay $3,000 for a coin that, 2 years ago they were paying $1,200 or $2,000 for. So the coin market's relatively weak, but we're seeing relatively strong demand in India, relatively strong demand in China, relatively strong demand in other parts of Southeast Asia, and you're seeing strong demand through the ETFs in Europe and North America. So it's there, and our expectation is that you will continue to see strong investment demand for gold this year, and that I think that we're thinking that it could go up about another 8% from last year, and last year was very high. I mean, we had 45 million ounces that we estimate were net investment demand in physical gold last year, and we're talking about 49 million ounces or maybe even 50 million ounces this year, depending on what happens in the second half of the year.
Well, Jeff, as you also look at the futures market, we were talking off mic that gold is currently on the August contract. Obviously, as we get further into July, that'll come more into the crosshairs. I think silver's already on the September contract, but with gold being on the August contract, are you seeing anything in the open interest? Are you seeing anything as far as how different commercials versus speculators are positioned?
Yeah, right now you've got about 31 million ounces of open interest in the futures market on COMEX for the August contract. And there's about 20 million ounces of registered, and there's another 16 million ounces of eligible but not registered metal. So you've got 36 million ounces of gold that meets COMEX qualities, specifications in COMEX registered depositories. So 31 million ounces probably is not indicative of a problem, but we do think that in the second half of July, which is where we're headed, especially in the last week of July, you'll see a lot of that 31 million ounces roll forward into the October contract, and that could apply some upward pressure on prices. We'll also be watching the deliveries, because if you start seeing major bullion banks taking delivery for their own account during the August delivery period, that might suggest, it could indicate that they are looking at liquidity issues in the physical gold market in the second half of the year, or in the last month of the year, specifically in late September going into October. There was a historical precedent back in 1999, I believe it was, where you saw one of the bullion banks take a large amount of deliveries in the August contract, and people were saying, why are they doing that? Because if they wanted to buy that much gold, they could easily buy it in the OTC market in a totally anonymous way. And our view was, they want everyone to know that they have that gold, because they're looking at what we're looking at, which is a potential for liquidity price problems in the physical market in October, November, and December. And they're broadcasting to the market, if it comes to be late September or October and you need gold, we have it. So we're going to be paying attention to seeing who's taking delivery for their own account in the August contract, because if you see the banks taking delivery of their own account, that suggests to us that they could be looking at and be concerned or interested in seeing a liquidity issue late September or early October. And just to close the circle, back in 1999, the price was trading like $260 an ounce in July and August. When they took that delivery, it spiked up to like $340 for one day in early October, and then came back off, and it was below 300 within a couple weeks.
So these things do, or can at least, cause some temporary price spikes or even drops, I guess. But Jeff, anything else that you're seeing on these COT reports that show you somebody's out of position, or that more people are taking notice, or really anything else that's catching your eye for COT reports?
The COT report, yeah, the major thing that I'm seeing is, on a year-over-year basis, you are seeing this reduction in institutional investor positions. The 14% decline in gross longs from a year ago. Again, up 6% from end of April, but down 14%. One of the more interesting things that factors into that negative 23% is if you look at the gross shorts. The gross shorts are up 39.5% from where they were a year ago. So as the price of gold has risen, institutional investors, there's been an increase in institutional investors who are saying, okay, I'm willing to go short here because maybe the price is approaching a peak. And even if it isn't a secular peak, there could be a downdraft, as there was in the stock market in the first 4 months of this year, only to see it come back and make new highs. So you're seeing institutional investors who play the futures market saying, as the price has gotten higher and higher, and it's sort of been moving sideways now since April, there's a potential that we could see a spike down in gold prices at some point. And there is.
Well, Jeff, if we widen the scope out beyond just the U.S. financials and politics and look at the rest of the globe, you've mentioned a little bit about China, but we were also talking off mic that the BRICS are getting ready to meet in Brazil. And so far, there hasn't been any indication that they're going to create a gold-backed currency, but you know what happens every time they meet. That's the kind of narratives that come out of the woodwork. Do you think there could be any wild cards, or is there any positioning in some of the BRICS nations that you want to note here for listeners?
Well, one of the more interesting things is that Xi Jinping and Vladimir Putin, neither of them are coming to this year's summit. And, Putin has a deep-seated fear of traveling abroad right now because he thinks that the International Court of Justice or whatever would grab him in some country. But Xi Jinping is not going this year either. if you look at the agenda, what the BRICS group of countries have said is they want to focus on reforming the IMF and the World Trade Organization this year. Last year, when they met in Russia, one of their big points was that they weren't looking to compete with the existing international financial institutions. They were looking to reform them. And they hoped for and were striving to help create a more equitable international financial system centered on the IMF. Those were their words, And this year, what they're saying is they want to start sketching out what they think would be a more equitable IMF and World Trade Organization set of rules and regulations. So that's one of the big things that they're talking about. The other thing they want to talk about is strengthening climate finance, financing for clean climate technology across the economy. So those are the two things they're talking about. They haven't really, from what we could tell, they haven't really created a formal agenda yet, or at least we didn't see it posted on their website. But other people related to them have posted agendas and topics. And again, there's no word about gold in any of it, and there's no word about a BRICS currency. So I think that that's what you're going to see in the BRICS. But yeah, as you said, that won't stop gold promoters from saying, oh, the BRICS is going to surprise everyone and come out with a gold-backed currency. And it would be a surprise, and it would be a surprise to all of the BRICS members if they did that. But its probability is probably less than 10%. So we don't expect that to be something that could surprise the gold market to the upside.
Oh, it's always a fun story to talk about, though. Hey, Jeff, what a different world it would be in if we did have a gold-backed currency anywhere in the world, let alone if the BRICS went there. But yeah, I feel like we talk about this every year, almost every quarter. Let's just take a, I guess, summary of everything that's happening here. That there are just a ton of catalysts behind gold. It's what has supported this much higher gold price. And it's not just one thing. It seems to be a confluence of factors that have continued to drive gold higher. But as I said earlier, we're about 2.5 months here of a relatively range-bound gold price, pretty much at all-time highs, but it has been range-bound. So what's coming? Where's the next catalyst? We're asking a lot of people this, but outside of the current narratives and the current drivers, where's the catalyst to either drive gold higher or lower?
Yeah, I think the possibility is for gold prices to come a little bit lower over the next month or two. You've got some seasonal weakness in investment demand, investors go on vacation, and in fabrication demand. And that could see the gold price weaken a little bit. We're not quite sure how low it would go. But yeah, as you said, it's at record levels. People are complaining that the gold price is so low. It's at record levels. It started the year $2,660, and it's $3,350 today. That's a really big increase already. In terms of catalysts to move the prices higher, we have a whole litany. And as you said, and we've been saying for 26 years now, it's a whole list of economic and political and social trends that are negative for people and negative for economic growth and negative for capital formation that are coming together and creating this ill ease on the part of corporations, institutional investors, and individuals. And that is helping them fuel their interest in gold and in silver as alternative assets. And one of the things that's so disheartening and concerning is the massive growth in money supply, not just in the United States, but on a global basis. And it's like, the dollar is strong because the dollar, we're pumping up so many dollars, people are worried about the economy. It's the same thing with gold. You see this massive increase in money supply, people get worried about that, and because there's this massive increase in money supply, they have more money to buy gold with. So it helps fuel the solution to the problem that is it. And I think that that's going to do that. But you have a whole list of things that could happen. There could be something in the South China Sea or the Straits of Taiwan. That's kind of lower level type of stuff. We're a little bit worried about North Korea because when North Korea isn't in the spotlight, when it's neglected, it tends to do some saber rattling for attention. Obviously, the big one is Ukraine and Russia. The United States administration, despite what the government of the United States has said, the administration has been holding back on weapons. Ukraine could get the upper hand if the U.S. would just get out of its way, but the U.S. government has refused to get out of its way. It's hard to say what's going to happen. We're hearing a lot of concerns about domestic issues within Russia, and you had another rear admiral killed actually by a missile from Ukraine in Kursk last week. You also had another minister who was fired, who then committed suicide. And you're hearing stories of economic and food security rising in Moscow as well as in other parts of the country. So we're watching Russia because, there seems to be growing dissent within Russia, and that could play either way. It could play into Russia not doing as well with the Ukraine war, or Russia trying to do something very desperate to bring the war to a conclusion and using much worse weapons than it has already. So we're watching that. And then you've got the whole tinderbox of the Middle East, which has been extremely unsettled. And we have no idea what Netanyahu and Trump agreed to yesterday in Washington. So there's a lot of stuff to keep us up at night.
Yeah, the world kind of seems like a mess, Jeff. Even when you consider what the U.S. is doing too. And this week that was dominated by tariff news, and now we just need to wait again. It's kind of crazy out there. But hey, that's probably why we see precious metals doing so well. But it's also in the backdrop of markets in the U.S. and globally doing very well. So what a weird and strange world we live in. We are out of time here, though, Jeff. So thank you very much for your time on this weekend show. Again, Jeff Christian, managing partner at the CPM Group. Everyone, stick around. We're going to be right back, shifting our focus over to the energy sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Your weekly fix on finance and investing. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, shifting our focus over to the energy sector, more specifically oil and natural gas, as we're chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also writes that Eye on Energy Report, which is now on Substack. I recommend checking out both of those reports. One being a little bit more focused on underlying equities, the other being big picture, what's going on in the energy sectors, as well as some of the ETFs that follow those equities. Joseph, one topic that I want to start off with here is North American production, comparing rig counts that I believe have been falling pretty much all year and overall North American production, which hasn't really been moving in lockstep with those falling rig counts. I want to start here because we get so many comments on the current price of oil, U.S. producers, at least new wells, don't make money at these prices. Trump wants to drill, baby, drill, but we're not seeing companies drill, baby, drill. But then we're also not seeing production fall off the table. So bring us up to speed on what you're seeing in the data, please.
Yeah, let's start with the rig count. The rig counts are down because the industry doesn't need to drill as many wells because they're drilling longer reach wells. They're doing multi-leg wells. They're doing pad drilling. So once the rig gets on the pad, it could have, 4 wells on a pad, 5 wells in a pad, sometimes even as high as 8 or 10 in a number of basins. So the rig count yet last week for the U.S. was 539 rigs working, down 8 on the week. and a year ago was 585, so it's down by 7.9%. On the breakdown between gas and oil, the gas rig count surprisingly is up 6.9%. It's 108 versus 101. And I think that's really because of more LNG plants coming on in the US. And so the gas has to be hooked up, that's contracted to go into those LNG facilities. The oil is down 7 to 425 from 479, down 11.2%. And that reflects the lower oil price, offset by the fact that the pad drilling is keeping production up. And I can go through that. The EIA data from last week, Friday, we'll get another report tomorrow. It's up 233,000 for crude oil to 13.43 million barrels a day, and that was 13.2 a year ago. You add in the 9.6 million of natural gas liquids and renewables, and you get the total number of volume in the United States of 23.0 million. And the demand last week was 20.5 million. So the U.S. is clearly self-sufficient, and its net exports, or its exports last week, were 2.3 million barrels. So it's shipping the light oil from the Gulf of Mexico, from the Permian and the Eagle Ford. It can't be refined in the U.S. refineries on the Gulf Coast. So they're shipping that to buyers who have less sophisticated refineries, and they're using more heavy crude, and they're of course using a lot from Canada. Canada, provides them probably half of their imports, about 4-something million barrels, and a lot of that goes to the Midwest and the Gulf Coast refineries. Also, right now, the Canadian numbers have been growing because the exports are now going also to the West Coast. The TMX pipeline is almost going to be full within 6 months to a year. And they're now talking, as you may have seen in the media, where there's talk of support for another oil pipeline from Alberta to the west coast of Canada.
Well, Joseph, just in listening to you talk and a little bit of our conversation off mic, it seems like in general, the industry is actually a lot more efficient than it used to be. Like you're saying, drilling multiple wells off of one pad, the ability to drill those longer holes, some of those holes going down 2 to 5 miles now, or horizontal holes, and just getting more life out of a basin. But the other thing that we hear a lot of is companies with their completions doing water floods and polymer floods to squeeze a little more juice out of the area. Do you think that, as a general statement, the industry has gotten a lot more efficient than it was in the past, and so it doesn't need to drill baby drill anymore to the same degree?
Yeah, I think let's break it down between the shale plays and conventional plays. On the shale plays, these multi-leg wells, be it in Canada, the Montney and the Duvernay, in the States being the Permian or the Eagle Ford or any of the other big plays in the U.S., and so it's more the shale plays. And so the fracking technology, the amount of sand they're using, the amount of pressures they're using, the plug and perf or whatever other techniques you're using, all of that helps to get the shale volumes up. And we're looking at record production there from the Permian that really increased the numbers, from I think U.S. going back, was under 10 million barrels of production in 2009, 2010. And so when you look at the amount of they had in the strategic reserve, they had about 80 days. Today, when you look at the fact that the net imports are only, 4.6 million barrels, then you look at the reserves in the commercial stocks, and you're looking at data that shows you're over 140 days of supply. So we're looking at, a situation that's changed there materially. Now let's go to the conventional basins, and this is where you have oil in place, and the initial production is flush, comes out, then of course it goes through a normal decline, and then you look at ways that you can use to get a higher recovery factor from 8, 10, 12% to 15, 20. That's where water floods come in. And then you could potentially take it up even higher than 20% with these polymer floods. And I bet you there'll be more technology coming about because the oil is in the rock. It just needs to find a way to come out. And so the water floods is first, polymer with water is second. And I bet you that over time we'll find new technologies that can help recover more. And again, a 1% increase in recovery can make a massive difference in production in the US and, of course, in Canada.
What's the cost profile of these new technologies? Is there, let's say, a baseline energy price, oil or natural gas price that is needed for these technologies to work and be utilized?
Some of the companies that are talking active quite regularly about using polymers, a company called Hemisphere, which has, a play in Alberta, which they've done a fabulous job, first with water flood, now with polymer. And what they've seen is, of course, flatlining their decline rates. And in fact, because they're adding more wells and more stimulant, they're having increases in their production. And so that's really been a win for Hemisphere. People can just go to their website and look at their presentation, and you can see the production profile. And Don Simmons and his team have done a fabulous job. And of course, it's helped, the stock has done well. They pay a very healthy dividend. So the total return for shareholders has been quite good in 2025.
Well, Joseph, when you look at nat gas, if we get into that a little bit, there is a big difference between U.S. gas prices and Canadian gas prices. Do you see that leveling off some? How do you see the trends in both countries?
Well, the U.S. has got, much better pricing. Today, we're looking at 335 for NYMEX, which is, very nice price, but to stimulate the industry to start spending a lot more money to bring on more production, you're going to need $4. But a lot of the natural gas, the reason why the price is where it is it's coming from those Permian oil wells as a byproduct. And so there's pipelines now that have been brought on so that if you want to produce more oil, you can't flare the gas anymore. So that gas is now going by pipeline to the Gulf Coast to be sold. That's keeping the price down. But as more and more of these LNG plants come on, we're going to see a tightening situation. And I think we're going to be moving north of $4 heading into the early winter. And I think in next year, we'll probably be looking at north of $4 average for the year for NYMEX. Canada's a different story. Canadian prices right now for AECO are under 80 cents an MCF, a really sloppy price. But again, if it's a byproduct of the condensate and the Montney Duvernay, the companies, as long as they get something, they're not worried about it. But to drill a conventional dry gas well does not make sense. The economics are not there. The only way you may want to do it is if you have a plant with a certain capacity, you want to keep the unit costs down. So you'll drill wells to keep the plant running at full capacity, even though the marginal cost of that extra molecule is not as profitable as you'd like. I think that we're heading into, you look at all of next year because of the LNG Canada working from the first shipment that came out last week and went to South Korea. We're going to probably be looking at 2 BCF by the end of the year. That will tighten the market up. And the forward curve for all of next year is over $3 Canadian. What a lot of companies have done is they've hedged to that AECO price. Others are selling in through the Alliance pipeline into the Midwest, so they're getting NYMEX plus. And others have gone into Dawn, which of course Sarnia area, and they're selling into the Ontario market, and they're getting much better pricing. Birchcliff being one of those getting that. So, there's companies that are stuck only in AECO and Station 2 that are not doing well right now. Others are doing okay. But the key thing is once we get LNG Canada up and running with 2 BCF and more projects moving forward, and BC seems to be interested in doing that, then I think we're going to see a tightening. And I think we'll be looking at a $3 Canadian price, while the US may be, $4. Then you take into account the exchange rate. That would be a real nice price if we got that in Canada. But we'll probably not get it until we get a couple more. By the end of the decade, we could have 6 to 8 BCF on an 18.5 BCF market. So right now we're maybe one of that being the LNG plant to train 1 on. Once train 2 comes on, that's 2 BCF. You start adding in all the other projects, and all of a sudden by the end of the decade, we're looking at a very big increase in demand, which means we need higher prices to generate the cash flow and capital to drill up the wells needed to meet those new LNG projects.
Interesting. That could be a big change to the market and huge for the Canadian producers. But Joseph, I feel like every time we talk natural gas, rightfully so, we talk LNG terminals and we usually talk weather Anything else in the market that investors need to be paying attention to, or you think people are maybe overlooking that could change the whole pricing dynamic, at least maybe as much as the LNG terminals, or to a degree at least?
Well, there's also a lot of demand in Alberta. Of course, the more you want to ship, the oil sands and SAGD oil, heavy oil into pipe, you're going to need more condensate, which means you're going to need to drill more Montney wells, and you're going to also need more natural gas for SAGD. So there is stimulus from there. The chemical refinery operations in the Fort Saskatchewan area are going to use more. Dow Chemical was supposed to be a big stimulus, but it's being delayed. But there's other projects that are coming on that will increase the demand domestically in Alberta. And of course, just bring data centers into it. If we want to have data centers, we're going to need to have more power come on. And of course, that power is going to have to come, it'll either come from, small modular reactors, but that's a way down the road and a cost we don't know about. But the easy thing to do would be to bring on more power from natural gas. And again, we're seeing, more of that happening in Alberta, BC, and we'll see it right across Canada over time if you want to have those data centers. So that's going to be a big stimulus to natural gas demand. And Alberta potentially could lead. But the issue is right now, our supply is tightening up. Summertime, of course, air conditioning demand. So if we want to have a lot of data centers, we're going to have to build a lot more. And you're hearing companies talking, Pine Cliff is doing a deal to provide natural gas to a power plant, to a data center. And we're probably going to see more bigger companies do one-on-one deals. And so that will be something that will be a positive, but not tomorrow, but down the road.
Yeah, it's a good point on the natural gas demand for electricity and power generation. And we're even seeing a few companies start looking at smaller modular nat gas plants that can be built into a series of plants, or even just powering the electrical needs of the energy companies while they're pulling out the oil, for example, and using the nat gas as a power source. But when you look at the contrarian angle, it seems like the most beat up sector between Canadian oil, U.S. oil, Canadian gas versus U.S. gas are the Canadian gassers. Do you see that as being a contrarian play to be in some of these Canadian nat gas positions now while they're weak before they have that run over the next year? Or would you still favor the U.S. gassers if you were just isolating it to the nat gas companies?
Well, I think the value differential is in favor of Canada for a couple of reasons. One, the reserve life indices are longer. A lot of the areas have not been drilled up, not even, there's still a lot of tier one inventory to drill. We do have coastal gas line in place, so gas will move to the West Coast. There's, of course, we talked about the data center need here. So when you look at the natural gas stocks, some of them have had a very good run. Today, for example, Birchcliff is over $7. It was $4.50 at the low in, April time. You go into names like, it's $23.50. It was $13 at the low. So there's been a couple of names that have done well. Paramount is $21.70. It was, under 15. So there are names that have done well, but there's quite a few others that are pretty, sluggish right now, where the numbers, because of the low natural gas price and the fact that they're not getting high prices from being in the alliance into Chicago or into Sarnia, the market and the hedge books were not big enough. Those are the ones that are suffering. And again, we all want to see, some decisions made that are, there's going to be carbon capture facilities, and if we're going to get oil pipelines, and we also need to see government show us that their new bill where they're talking about fast tracking, is it going to be really fast tracking, like the US where they're saying they want things to happen in, very short order. And the EPA, Secretary of the EPA in the States, his job is to, you cut through the red tape and make things happen. And, he's being seen as a major player in the Trump administration.
I was going to ask you about that Canadian politics angle, though. What do you see happening in Canada in terms of the political angle towards the energy sector?
Well, we don't hear much out of Quebec, but the Premier of Ontario has been here out in Alberta for Stampede and, talking positively to support Daniel Smith and pipelines to Ontario, pipelines to the West Coast. You're hearing from the Premier of Manitoba that he'd like to see pipelines from Winnipeg up to Churchill, and also maybe a pipeline from Fort Saskatchewan or Fort Mac to Churchill. So there's a lot of potential new positives there. The stumbling block would be the Quebec leaders that are a plethora of the cabinet ministers in the federal government that are anti-energy, anti-Alberta, and climate demagogues. And I think that's the question mark is, how does Mark Carney skate through that when he says he wants to increase the pie, increase the wealth of Canada, increase the economy of Canada. At the same time, he's got these leftists who want to shut us down, when energy and resources, be it potash, be it uranium, be it grains, are really the lifeblood of a lot of the provinces, especially in Western Canada.
Yeah, it's an interesting push and pull between political posturing and then the reality of policy actually enabling more growth in the resource extraction industry. So we'll keep tabs on it both in Canada and the US. If we shift over to some of the oily or names and the companies, Joseph, you always have some interesting thoughts on how the price moves in the macro with oil will tie into the potential areas to buy the companies. We've had a nice bounce in oil. Some of that was geopolitical related in the last couple of weeks to month, but oil price is still hanging up in the mid, WTI is in the mid to high 60s. Are you expecting a pullback where we can get one of those table pounding buys, or how are you looking at the oily names and the oil price?
Well, when you look at the fact that the number for last week on the commercial stocks was an increase, so we're in the summer driving season when you think you'd see stocks coming down, but the commercial stocks rose 3.8 million barrels to 419 million. So there was an increase last week, and the overall total stocks grew by 9.6 million barrels to 1.64 billion barrels. So we're looking at a build at a time when you should be looking at draws. So I think that as we get more weeks like that, I think we might see right now the last $3-4 to the 69 level is all because of not the war in the Middle East, Iran, like it was before. Now it's the tariff war that people are becoming nervous about. And remember, the markets don't like uncertainty. So we're seeing a bounce there. I think there's still a chance for us to have a peak going down even below 60 again sometime, over the next 2 or 3 months. So I wouldn't be chasing stocks here. I'd be building up your buy list again. And I think we'll get another strong buy, table pounding buy like we got in April. And if you remember, we were saying table pounding buy. We gave you a lot of new names to buy, and and we thought it was like kids in a candy store. That's how cheap stocks were, and you had stocks with good dividend yields. You had some yielding over 10%, some even over 11 and 12. So, and companies with balance sheets that can afford to pay those dividends. So those yields have come down with the big bounce that we've seen in a lot of those stocks. And my guess is that if we get the builds in inventory and, this whole thing with OPEC, that's another issue to talk about, is OPEC's now talking about increasing their capacity by 548,000 BOEs a day in August. They were supposed to have done in May, June, and July 411,000, but all it is really increasing quota for countries that are cheating. The total growth in the production of OPEC during the month of May was only 183,000, not the 411. I've got the report right in front of me. And the biggest increase came from Saudi Arabia, which raised their production by 177,000 to 9.18 million barrels a day. Others either have production problems because of their facilities, or there's an issue that they were overproducing and they were getting back in line to the quota at the time. So all of this new production that they're saying they're going to bring on may just be quota changes and not real volumes. The only countries that really can bring on real new volumes are Saudi Arabia, maybe 500,000 to 1 million barrels, and maybe a couple 100,000 from Kuwait and UAE. All the others, will probably have problems, meeting these new quotas that they're getting. And remember, Venezuela is now, under U.S. tougher sanctions starting May 27th. So far, they've been able to sell more to China. But if the U.S. puts more and tighter sanctions on shippers, insurance companies, etc., that's going to make the production numbers harder for Venezuela. And if you lose 500,000 barrels there, that will tighten things up sometime around year end.
Well, Joseph, on the equity front, since we're not at that table pounding buy yet and you're building up your watch list, do you care to share any of the top companies or just any companies that are on your watch list right now that we should be watching?
Yeah, on the service sector, I'd be looking at CES. The stock's backed off. It's about $7 today. It was in the sixes, and if it gets 6.25, 6.5, I think that'd be a great buy on the service side. I think Pembina Pipeline, which is trading at $50 today, you're looking at a company there with a, 5.5% dividend yield. And again, it's come down a lot. Pembina was trading at the high $60.72. So it's $10 off that number, just over $10 off that number. So that's a potential one to keep an eye on. And then I'd be looking at, some of the service sector names, Ensign, Total Energy, and Trican just did that big deal. So the stock popped. If that stock backed off, I'd be interested in it. And then keep an eye on things like, Bonterra, Strathcona, Surge, Valura. We were talking so many names in early April. Now we don't have them as much, but I bet you that sometime when we have a future conversation, I'll be saying, well, in conservative, I got these 5 or 6 names. In growth, I've got these 5 or 6. Entrepreneurial, these 5 or 6. Right now, I would have maybe, one name or 2 names in each sector, but, the stocks could back off 5-10%. So you got to keep that in mind and maybe just average in on those names. But Bonterra would be in that group, Marin would be in that group, Pembina would be in that group. So there's a lot of names. Yangara would be in that group. So, just be patient. And when you get those windows to buy, so in the meantime, if you're getting dividend income off of your Surge and your Topaz and others, just hold that cash. Wait for the windows to open up again, like Pembina, off $10 from its high. That's a big move for a big stock. And so, if you look at, if you're an infrastructure buyer with dividend yields, with a great business, Pembina would be my first choice. On the service sector, it would be CES. On the international oils, it'd probably be Marin. On the domestic oils, it would be Bonterra. And on the domestic gas, it would probably be Yangara.
Well, Joseph, just for those listeners that maybe don't play the individual companies, I know you've also been looking at some of the larger ETFs that are more US based, but have a mix of domestic and international companies. What about something like just looking at the XLE, which is the larger producers, or OIH, which are the service companies?
Yeah, the XLE is today at $88.50. It's up $2.34, up 2.7%. We're having a good day because there's almost $1 increase in the price of crude oil, and all the tariff stuff is making the uncertainty there. But the XLE was as low as $74. Now it's 88. If it backed off below 80, I think that was where it was in April, I think you'd want to have a buy on that. And then the OIH would fall into, look where it was in April. That's really the kind of thing, is get within, 5-10% of that low in April, and that would be a good buy. And if you're fortunate enough that we have a shakeout in a couple of bad days, you may even be able to get prices close to those April lows. And that to me would be a buy signal again. I'm watching the bullish percentage index, and it's pretty high right now. If you look at the CNN Fear and Greed Index, we're at the high end of the greed side. So you look at the 50-day moving average on the S&P 500, it's at the high end. So there's a lot of reasons to be a little more careful now and just to build up cash reserves to be able to be a buyer. I'm not a trader where you can say go in, go out, and try to move for 5%. That's not my skill set. But for major buying windows where you can buy stocks very cheaply and buy them and hold them for multiple years, that's where I think we add value. The last time we were able to say that was in April, and I bet you there'll be another buy signal in the weeks or months to come.
All right, Joseph, thank you very much for joining us on this weekend show. Again, Josef Schachter, the founder and editor of the Schachter Energy Report, and writes the Eye on Energy Report, which is now on Substack. Everyone, thanks for tuning in to this weekend show. Boy, oh boy, a lot happening this week, and it just seems like even though we are in summer or close to summer, the news does not slow down and these markets continue to be quite volatile. Something that gives us a lot to talk about on a day-to-day and week-to-week basis. So please keep tuning in to our website, podcast, and YouTube channel for all our daily editorials and company updates. And as always, keep in touch with Shad and I through email. We love hearing from each and every one of you, and we do our best to get back to you all in a very timely manner. So Joseph, thanks again for joining us. And everyone, thanks for spending some of your weekend with us. I hope you all have a great rest of your weekend.
To find out more about today's guests, visit us on the web at www.kereport.com. You're listening to the Corlin Economics Report. We'll be back in a moment.